Yeah. I'm breaking out so bad too.
I will say good morning or good afternoon to everybody. I don't have my camera on. I apologize, but we are going to get started here in a minute. And Jeffrey is going to be our host to introduce today. So hello, everybody. Jeffrey, I'm going to turn it over to you so you can start greeting everybody.
Okay, well, just let me know when you want me to start the actual.
Well, I think we're going to start right now because we are at 12:33 and we're 3 minutes in and everybody's here, especially Will. I saw Will Dorlick on there, so Will's here so we can get the meeting started.
Okay, so hello, everybody. I'm Jeffrey Neidelman. I'm the 2025 president-elect for Bridge Association, and I'm very happy to be here and be in front of Jordan, who is a celebrity at C.A.R. Of course, he is the person everyone goes to. He knows everything about everything. So here we are. Let's start out with just the beginning. I want to welcome any new Bridge AOR members and affiliates. If you're on this call, thank you for coming, and I hope this is useful and educational for you. Um, at Bridge, we have a couple of upcoming events that I just want to bring to everyone's attention. Uh, First of all, every Monday morning at the Bridge AOR office, we conduct our marketing meetings. So this is a chance to get to spotlight your listing or talk about your your network and listen to a speaker of the week. It's a chance for people to just get together. Those start at 8:15 with a breakfast, and then the meeting starts at 8:30. And there's no registration required. So you can come to our office on Telegraph and participate in those meetings. In October as well, we have a power hour, which is the conducted by the Education Committee. It's an in-person power hour featuring a panel of top producers where you'll get a chance to hear their insights, ask questions, and enjoy networking as well over a provided lunch. And the next one is on October 22nd from 12 to 1:30 p.m. And it's again held in person at the Bridge AOR Training Center on Telegraph in Berkeley. The registration details will be on the Bridge AOR website and the member portal. The other thing is Bridge's YPN network, Young Professional Network, is going to be holding a masquerade murder mystery for an evening of suspense. Unmask new friends, uncover hidden clues at this twist of during their annual masquerade ball, which is November 6th from 6 to 9 p.m. And again, you register for this on the Bridge AOR calendar. So check the website as well for any upcoming events, trainings, or courses. But this should be a really fun way to meet other people and just have some fun. So finally, we're at the place where I want to introduce Jordan Levine. Um, Jordan Levine is the C.A.R. Senior Vice President and Chief Economist. He is the senior, so he's responsible for economic and housing market research as well as policy analysis for C.A.R.'s legislative and advocacy efforts. He has a BA degree in business economics from UC Santa Cruz and a master's degree with merit in international economics from the University of Sussex in England. Jordan is a California native who grew up in San Diego and has lived all over the state. He currently lives on the Central Coast with his two kids, where he enjoys camping, the dog beach, and evangelizing for e bikes. His work is relied upon by realtors, consumers, business leaders, and policymakers alike, and is of course a regularly featured speaker in local and national media. So with that, welcome Jordan, and we appreciate
Thank you.
being here and look forward to what you want to report to us.
Thank you, Mr. President-elect. I appreciate the opportunity to be here and to speak to your members today about the outlook. And actually, it's kind of hot off the press. I'm going to share my screen so we don't all get traumatized by looking at my face the whole time. And I'll move these out of the way. Also, try and keep an eye on the chat. But this is a very fresh forecast. We just did it out at Chula Vista I guess it's a few weeks ago now. So, but unlike other years when I've delivered the forecast and pretty much the second I walked off stage, it was already outdated. This one is still more or less good to go as we sit here today. So I'll give you a little bit of an outlook on where we think the economy is going to go, where we think, which I think, by the way, is going to be particularly relevant for folks in the Bay Area. We have just a very like macroeconomic driven housing market, not necessarily because of interest rates as much as you might think, but more so, I think, on the stock market side. And when the stock market's booming, so is Bay Area home sales and vice versa. And as that has been a very volatile part of the market, we've seen a lot of ups and downs and transaction volumes in the Bay Area of late. So we'll go through some slides, and can you guys all see my slides? Jeffrey, can you see my slides? All right, good. Yeah, awesome. This was what I forecast for you last year when we were in, I forget where we were, Anaheim or Long Beach or something like that. We thought that the macro economy was going to essentially avoid a recession, but see slower growth than what we had enjoyed up to this point. We forecast a 1%, 1.1% expansion in GDP. We had ongoing job growth, but only a little bit, right? 0.5% for job growth, and unemployment staying below that 5% threshold. So if you go all the way back to October of 2024, this is what I said 25 was going to look like. This is what I said this year was going to look like. If you kind of fast forward to what's actually happened this year, thus far, we're basically at a 1.3% economic expansion. So it was actually a little bit better than what I forecast back in November of 2024. You also saw job growth that was closer to 1% than it was to 0.5%, which was the forecast. So again, macro wise, things did even better than we thought it was going to do, right? We continued to grow despite all of the volatility, uncertainty, new administration, all of that stuff. The underlying fundamentals continued to move ahead. Again, not as fast as they have been up to this point, since we started the recovery from the pandemic, but that is more ongoing growth and even better than was expected. If you I show you all of that just so that you have some sense of how terrible or not I am at forecasting when I tell you that we're expecting more of the same moving forward. We didn't nail it, but I would say that was about a B plus, right? We had avoiding recession, modest growth. Things were a little bit better than what I told you they were going to be, but it wasn't dramatically off base, which is why I feel kind of confident in telling you that we don't know what's going to happen, but based on what we see right now, it's more of the same. Ongoing growth, narrowly avoiding a recession, punctuated by lots of uncertainty and volatility, policy and otherwise, that will kind of constrain overall growth, but also mean that some of these dire prognostications about deep recession, major imbalances probably aren't founded either, right? So you don't want to pop the champagne corks and overly celebrate because it's not a bounce back V-shaped kind of robust acceleration in underlying economic growth, but you don't necessarily need to pop the top on the antidepressants either. It's not going to be too terrible. It's not going to be too amazing. And I think from a real estate practitioner standpoint, what it means is just that, yes, things are going to get better, but no, you can't just rely on the economy or the overall size of the market to do it for us, right? It's still nose to the grindstone. Even though we've been waiting for this return to baseline and things to kind of go back to normal, this is about as normal as they're ever going to be going forward, I think. And so we're just going to have to constantly, yes, there will be more transactions, and we're forecasting not just the economy, but home sales to go up too. but it's not going to go up so fast that you can just rely on that, right? It's not how many home sales there are going to be this year. It's how many transactions am I going to do of whatever happens to take place, right? That's the part you can control. And I think that we have to have that mindset because again, things will go up, but not so fast that it's going to be like an embarrassment of riches where even with no effort, new listings and buyers just show up in our lap, right? So it's nose to the grindstone. If you look at what we were projecting, right, we take that economic forecast and then extrapolate that out into housing, right? What does that mean for housing? So we saw that the economy was going to keep growing. We were already seeing increasing numbers on active supply, right? Active listings out there. And so we thought with more jobs, more income, a better economy, that will lead to a modest uptick in home sales. So we had 24 going up a little bit. And again, this is still my projection from last year, just to give us some set the stage, right? But we thought that that economic growth and the economy did better than what we even projected would translate into modest upticks in sales to 275,000 last year, up from the bottom of about 260, and then another 10% increase in 25, taking us back above that 300,000 unit level for the first time since the start of the pandemic. Well, here's the weird part that even as the economy did better than we forecast, transactions did worse, right? So we had more economic growth, more jobs, better income growth, lower levels of unemployment, and yet that didn't translate into an uptick in home sales this year. And that just goes to show how much of this housing market is driven by not just the economic fundamentals, but people's perception of where the economy's at, right? Because the economy did great, but because we're so worried about what the economy is going to look like 3, 6, 12 months down the road, it puts us in a holding pattern today. And if you kind of look at how that tracks in the Bay Area, last year we did even better than the rest of the state as a whole. We were up a little bit statewide by about 1%, right? But the Bay Area actually had a noticeable increase in transactions, and we're actually doing a little bit better than the rest of the state through the first 9 months of 25. So we're missing some sales there from this final bar, but you can see that it's not enough even as we outperform the state, right? And this jump from 23 to 24, you can actually see it with the naked eye versus having to like calculate it in a spreadsheet the way that we do at the statewide level. That bounce still isn't getting us anywhere close to where we were, forget 2021 when rates were 3%. That's not even taking us back to 2015 levels of transactions, right? So this is why even as I'm optimistic about the market, going up this year, we've got a long way to go just to get back to what we used to think was normal. So improving, yes. Foot off the gas, no. Um, if you look at what that means, like on a percentage basis, right? Again, last year in California, we were only up a little bit, couple of percent, right? We almost got a double-digit increase in the Bay Area, partly because the stock market was at an all-time high still last year, and that volatility didn't really kick in on the S&P until the first quarter of this year, translating to an even more robust housing market because we're overly dependent on stock gains and what happens with AI and Nvidia than places like Fresno and Bakersfield and things like that. So when the stock market's doing really well, home sales are doing really well in the Bay Area. Now that we've had a lot of volatility and have only recently seen those stock numbers start to go back up after really having plateaued for a long time, is that home sales this year in the Bay Area are essentially flat. Again, you don't have to panic about a -1%. That's essentially, we're just doing what we did last year. But the point is that we just don't have tons and tons of momentum that's driving this kind of rocket ship of home sales up in the right direction. And if you kind of dig under the hood of why the Bay Area performed so well in 24 and why it's not doing as well now, it starts to become clearer where that kind of growth was and where the weakness is and just how closely tied we are to stock market performance. Because when we were, outpacing the state by a factor of 3 to 1 last year, it was, where was that growth coming from, right? The tallest stuff is blue. That's 5 million and up, right? So when rates were really low, or even last year, right, when the market was up 9%, it's because 5 million and up in the Bay Area was up 35%, right? Same thing. Now that the market's essentially flat, 5 million and up still growing, but only by 15%. And everything else is either flat or negative below 5 million. And so that gives you that kind of overall flat and negative number. So when the stock market's really good, top end explodes. That's enough to offset weakness at the bottom end of the market. What's interesting about this chart is that the orange stuff is negative the entire time, right? Even when interest rates were 2.5%, you weren't seeing all this explosive growth in home sales below $1 million in the Bay Area, unfortunately. Those are the most difficult homes to find and buy, right? In fact, if you can find them, let me know. I want to try and borrow some money and buy as much of them as I can. Because if you look at like underlying supply and demand, all these people are scared off by the cyclical aspect of the Bay Area housing market and forgetting the long term, is what led us to these $2.5 million median prices that we have, and why you should have bought a long time ago, but you should still be in a hurry to buy. I think you can underscore that by showing them this chart. This is that same chart that I showed you earlier on Bay Area transactions, but instead of showing you the number of home sales, I'm just showing you as a percentage, right? So think of this as a pie chart over time, right? What percentage of the housing market in the Bay Area has been in these various price segments, and you don't have to go back that far in time. We're thinking post.com housing bubble, all of that stuff. Even in 2015, about 70% of the homes that sold in the Bay Area were selling below $1 million. Now it's, just only slightly better than 1 out of 3 homes are below $1 million. They're becoming an endangered species, right? When you look at this chart, it's, you start to ask yourself why, show me a point on this chart when it was a good time for you to wait on the sidelines to become a homeowner in the Bay Area, because you don't need to, be a mathematician to see that, the gray and the orange and the yellow and even the blue is disappearing. The San Francisco Bay Area is classified as the 9 county Bay Area. So you'll see in a second, I have all the individual counties broken out here. I know this is mostly like an East Bay centric group, but I think based on what I've seen in the market data, it's like you guys are doing transactions all over, because you got people coming in from the peninsula and going, as far out as Martinez and all kinds of stuff. So I was and ultimately driven by the same macro trends. But great question. This right here is the 9 county Bay Area when it says Bay Area on these charts. And again, you can kind of show the same thing, but the point being is just that the affordable entry-level home is becoming an endangered species in the Bay Area, because on the one hand, we have one of the most powerful economies the world's ever seen, and at the same time, we've massively constrained the amount of new homes that we bring into that economy every year. And so we've commoditized the housing market. Old homes that are 70, 80 years old and used to sell for, 60, 70,000 in the 70s, early 80s are now $2.5, $3 million homes. And that's just basic supply and demand, as we'll see here in a second. But that's also how you end up with charts like this, right? That the median price across the board is rising no matter where in the Bay Area you are. And these are lowest to highest, right? Solano County now costs almost $600,000. That's the median price of a closed transaction. And that's the affordable part of the Bay Area, where you're still facing relatively brutal commutes and still pretty high home prices by the standards of the rest of the United States, all the way up to, San Mateo and Santa Clara, which are well in excess of $2.1 million. What's also interesting about this chart is that this includes a period in time when interest rates doubled, right? And you can see that there were some exceptions where prices moderated a little bit, but almost very quickly, even in those markets, right? Like San Francisco, where prices took a bit of a breather when interest rates doubled, they very quickly resumed that upward trend and have now been rising for 2 to 3 years consecutively. So again, this idea of waiting equals saving a lot of money, I think, is not founded in or rooted in the data, but it's still, psychologically, whether it's backed up by the economic data or not, you've got all this uncertainty driving buyers to sit on the sidelines and kind of have missed the boat as prices have continued to rise, and yet rates have stayed basically exactly the same as where they've been for the last 3 years in a row. I didn't belabor the geographic stuff up to this point, only because I think the story is more one of price points, right? It's more about where you are on the economic spectrum versus where you are geographically. And it's the top end of every market that's done the best. The top end of Contra Costa, the top end of San Mateo, the top end of Alameda have all punched above their weight. The entry level of all of those markets have suffered across the board. When you do look at it geographically, you basically just see the same story that I told you about price segments borne out, right? Because look at 24, right? Like when the market was up by 10% across the entire Bay Area, it's because, and again, these are sorted from lowest on the left to highest price within any given year, right? So Solano's the first bar, then Sonoma, then Contra Costa, then Napa. The bars are highest on the right side, right? That you get more growth in the more expensive, more affluent, more concentrated with folks at the upper end of the economic spectrum, driving higher end home sales, vacation second home sales, investment properties, et cetera. Right. And as the market has faltered, those ones that were doing great at the very top end, particularly, although you can see the peninsula is still the only part of the Bay Area that's growing this year, but it's not growing by so much that it's canceling out weakness in Solana, Sonoma, Napa, et cetera. Um, why not? Again, it's not because the economics were worse. I just showed you how we outperformed forecast and avoided recession, but there's been, I couldn't even fit them all on this one slide, but there's been about 42,000 curveballs that have come down and individually moved the market almost every day this year. And that's why, even as unemployment's low and GDP is high and jobs are high and all of that stuff, that people are waiting to make big moves when it comes to cars, homes, job changes, et cetera. There's a psychological component. I call it the brother-in-law effect that's really keeping a lot of people on the sidelines because they're waiting for the foreclosure, they're waiting for prices to tank, they're waiting for the stock market to blow up, they're waiting for the Fed to deliver on more rate cuts and get a 4% interest rate for mortgages again. All kinds of reasons, which many of which are probably not supported by any kind of logic, but nonetheless are keeping people kind of sitting on the sidelines. We saw that job growth has dramatically slowed this year. And although that doesn't mean unemployment's going up, the jobs aren't as plentiful as they used to be. This is still positive job growth, right? You can see we're adding fewer jobs each month than we were last year. We're still adding jobs. Nothing to panic about, but because jobs, aren't as plentiful, people don't feel like they can up and quit and go double their pay as readily, right? And you can see in the unemployment insurance claims, particularly the orange continuing claims, that it's taken workers, newly unemployed workers, longer to get back to work, right? They get unemployed. They were on the unemployment roll this week. That's the blue stuff. The orange stuff is all the people from last week plus all the new people this week. And those numbers are going up, not because the blue is shooting through the roof, but just because more and more of these people are lingering on unemployment longer. Not that the economy is falling apart, but there's this kind of sense of trepidation. It's not just buyers who aren't getting new cars and new houses. Employers and businesses aren't going out and making big investments or expanding their payrolls because they're waiting to see what happens too. And there's all this kind of trickle down through the rest of the economy into, overall growth and home sales and all of that stuff. Unfortunately, we're on the leading edge of this, and you can see that jobs here in California have been flat across most of our major markets for all of this year. Unfortunately, for those of us on this call, the Bay Area is leading the pack on that. We've been down basically since the end of 22. Pretty much when rates doubled in that third quarter of 2022, job growth really slowed down in the Bay Area, and it was followed almost immediately after that by the failure of Silicon Valley Bank, which created a lot of stock market volatility, point blank. And we just talked about how that impacts home sales in the Bay Area, but also it really, for a minute there, dried up a lot of the venture capital money that was really driving a lot of the growth that was happening in our underlying economy. You put all of that together with a weak housing market over that time, and we've been leading the pack. Yeah, no, Barry, you didn't miss anything. Maybe I missed stressing that, but I would just like to finish my point there real quick before I answer is just that, all of that has translated in the Bay Area economy being flat to down now for about 2.5 years consecutively. And I think that also underscores some of these new structural challenges that we're going to be facing. Because on the one hand, the Bay Area is still benefiting from this new wave of jobs, right? The AI boom and all of that stuff. And there's like lots of people coming in with these multi-million-dollar a year jobs. But the Bay Area is also an early adopter of these technologies and tends to be on the bleeding edge of that stuff too. And I think what you're seeing is that in the face of all of this uncertainty, they're becoming even earlier adopters of, these AI bots and large language models and things like that as a way to still meet their customers' demand without having to go out and hire a bunch of people while they wait and see what's going to happen with rates, with trade war, and all these other various things that are kind of percolating out there on the stock market stuff, leading to the Bay Area kind of being ahead of the curve when it comes to some of the stuff that's plaguing California as a whole. And also, I think, going to start to bleed out into the broader macroeconomic environment. To get back to Barry's question, which for those of you not tuning in to the chat, asked, the macro data says that we should be seeing a lot more home sales than what the economy would suggest. Couldn't agree more. We have 2008, we have worse than 2008 financial crisis levels of transactions, despite all-time highs across almost every major economic indicator. Part of this is structural. And we'll talk through in a second some of the impediments to home ownership and getting first time buyers into that entry level of the housing market. But even with all of our challenges there, we should have a lot more transactions and a lot more new homeowners than we've been able to create over the last 4 years. Part of that is just this brother-in-law effect. Part of it's a financial literacy thing. Part of it's just a fear, a 2008 kind of psychological scar tissue deal where people don't want to be the last one into the market. We've also got different challenges for people to move, right? The existing homeowners, even though actives are up, they're still depressed by any other stretch of the imagination outside of the standards of the last 2 years, meaning that there's still not enough homes left to sell to get back up to 400,000 transactions in the first place. So great question. We should absolutely. The economy is supportive of way more transactions. A lot of this is psychological. I'm not going to go on too much about the economic data other than just to say that we've got some concerns there. Most of our eggs are in a few population driven baskets, and our big, fast growing sectors, like the ones we enjoy having in the Bay Area, are the ones that are flat to down. Part of that is, again, a lot of this uncertainty and employers going on pause and also replacing human work with robots in the meantime to kind of make do while they wait for the dust to settle. This gets to some of what Barry was bringing up on the structural change and why we haven't had as many home sales now, despite the overall economy doing really well. It's because not everybody shares in these gains that the economy's produced over the last 50 years. This is, a powerful chart and a depressing chart, but it used to be the case that as worker productivity improved, yes, I think yes, Evangeline, absolutely right. Part of this, the low hanging fruit, is the financial literacy piece. We're going to work on the structural issues over time. Short run, though, you got a lot of high income, gainfully employed renters in the Bay Area that are paying somebody else's mortgage instead of their own under the false misapprehension that rates are going to plummet, that there's going to be a bunch of cheap foreclosures to buy later this year. And that's simply not the case. But when you think about why the overall number of transactions aren't high, it's, I think partly because of this. If you go back historically, used to be the case that as workers became more productive, you could do more with each worker. That funneled down and filtered down in the form of worker wages, right? You could see this gray and orange line used to be on top of each other, meaning that there was pretty much a pound for pound improvement in productivity, improve people's wages by a similar amount, right? And that led to labor income as a share of overall income. You can add up all the gains the economy makes and look at how much of that gets paid down to workers as incomes and how much goes to returns to capital, the people who own the equipment, the computers, the software, what have you, right? Used to be 74%, as much as 72%, even at this time before things diverged, of the economy got paid back to people who were doing the work. And over time, that's really diverged because so much of the productivity improvements haven't been us figuring out how to use tools better and all of that stuff. It's been mechanization, automation, doing stuff with factory, with conveyor belts, with computers, with software, with the internet. And increasingly, it's been the people who owned those means of production that have gotten the benefits of the economy, such that, you know, the gray and the yellow have really diverged dramatically, and the labor share of income now is down at almost 2/3. So it's just, the economy on the one hand is at all-time high levels, and I think that's how you can see charts like this, right, where all of the GDP added up across the entire country as higher than, you know, humanity's ever seen. There's never been an economy that's generated more GDP than we did. No economy's ever generated 25, 26 trillion dollars worth of personal income in recorded history either. And yet, simultaneous to that and coexisting with that, we've got consumer feelings out there that are at 2008 financial crisis levels, right? People were less optimistic about the economy in April of this year when the Dow was at 44,000, unemployment was at 4.2%, than they were back in November of 2008, when, you know, the economy had tanked. 12% of people in California plus were unemployed, and the stock market had just been cut in half. I think, you know, it's the trickle down economics part not working, and then I think, as we'll see in a second, also, you know, it's just that, you know, we've got a additional self-inflicted wound here in California, where we've also put people behind the eight ball from a housing supply standpoint. You know, not only do we have these big structural changes, you know, look, computers, machines, software, that's all good for us, right? But we just have to make sure that people aren't being left in the dust by these changes, because it's created new industries and all that, you know, and a lot of people are doing better than they ever have before, but not everybody, right? And there's this kind of divergence between all-time high aggregate macroeconomic data and people out there looking at $30 packs of bacon and deciding what bill they're going to pay and which ones they're not going to pay. And that's like coexisting at the same exact time in this kind of economy that for some has been great, right? On the one hand, we've got all-time high economic indicators. If you look at aggregate income indexed in real terms over time, going back to the 80s, we're 3.5 high times more in terms of total income that this economy generated. And yet the median wage, once you take out the inflation, on an hourly basis, is only 17% higher than it was 40 years ago. Or how long ago was 1980? Don't tell me. So, you know, the point being, though, is that there's this gap between, you know, all of the gains, or a juxtaposition, I would say. I don't want to use the term gap. I think nomenclature is important, but there's this juxtaposition between how well the economy's done and how many of us have experienced that same kind of rocket ship ride. And then, of course, we also made matters worse here in California, because not only are you now competing against the computer and the robot and the conveyor belt and the driverless car and all of that stuff, but now you're facing a housing shortage that's gotten increasingly worse over time. Go back to the 1970s, before those two numbers diverged. California built almost 2.2 million homes, right? That's like, what is it, 220,000 homes a year, basically, for a decade straight. And we were only a 20 million person state. Fast forward to 2000 to 2010, we barely averaged 140,000 homes a year, and we were a 40 million person state. So, you know, you want to try and explain the Bay Area's $2 million median home price, you can look straight at this, right? You go from 20 to 40 million people and go from building 240 to 140,000 homes a year. Simple as that. It's Econ 101, right? And it's actually, the numbers are getting worse, not better, unfortunately. This is the recent decade of building permits here in California. The only reason why these numbers are going up, and you might think like, hey, great, the problem solving itself, these numbers are going up, that's an upward trend. It's only because of this blue stuff, which is the ADUs. And that's the one part of California public policy that's worked over the last decade. But unfortunately, we're not going to dig our way out of this housing crisis purely on the backs of ADUs. And when you take that blue piece away, picture doesn't look right. This is why the best time to buy a house in California was 20 years ago. And the second best time to buy a house is as soon as you can, because we have a powerhouse economy. People who live in the Bay Area look around and you see there's a lot of Teslas, a lot of Bentleys, a lot of really nice cars, a lot of wealth being generated, no homes being generated, which is why you got 40, 50, 70-year-old homes that cost $2.5 million because the, there's, there's an outlet for this demand and it shows up in higher home prices, right? And so I think that's why you don't wait around. It's a simple problem, right? You look at California, we're a 40 million person state. Over the last 5 years, we built about 550,000 homes. Almost, most of these states, regardless of the size of their population, did almost as well in terms of, building units. Florida is only slightly more than half the size of California, and they built twice as much as us, right? And their homes cost half as much. Unfortunately, it's not rocket science, right? You look at Tennessee. Tennessee, it takes like 5 Tennessees to make one California, and they built half as much as us, right? They're destroying us when it comes to housing production, and that's why people are moving to these states because you can afford to own your own home, right? That's why only 15% of Californians can afford the median priced home. Only 29% of Californians can afford an 80% of the median priced home with only 10% down payments, right? We're talking about 70% can't afford to get their foot on the property ladder in California. And that's a recipe not just for lower numbers of home sales, right? And home sales that don't match up with what the macroeconomic data would suggest that they should be, right? But also with a broader economic crisis on the horizon of how do we keep the economy going if no one can afford to live here then, right? And we see, that's only getting worse because of the underbuilding, but also because of, the changes that we're seeing happen out there with climate and fire and risk and insurance and all of that. And that's becoming an increasing issue that's only making our affordability challenges that much more acute. The good news is when you build new housing, it actually does help, right? It helps to build market rate housing on low income folks. And contrary to what you believe or have read, new development actually improves the value of your own home. So one of the main things I hear is like, this is going to destroy my house's value. And they put up all these apartments. We do want to be thoughtful about what we build, and I think you can get a lot of the way there with look and feel, not destroying neighborhood character. But be that as it may, there's not a lot of good empirical data that suggests that new development destroys property values. Actually, I went through over the last month and read, oh, look, I'm high-fiving myself. I don't know how I did that. Sorry. The academic literature is pretty clear that there's a statistically significant positive impact of new development on existing property values. If it's done well, it comes with amenities. It improves the demand of the neighborhoods. There's no reason for us to get in the way of this stuff. For home sales, for our neighborhood value, for the future of our economy and home ownership. It's all of the above. It's a win-win-win, and we got to get serious because when we don't, you end up with stuff like this, where only 55% of Californians can afford their own or own their own home now. And this is the one and only way that people accumulate any wealth in this country. So we've got to be able to deliver on the American dream in order to still have a powerhouse economy moving forward, right? If you look at who has the wealth in this country, you can see that renters are no richer today than they've ever been. And the only people that end up accumulating wealth are the people who own their own homes. And that's not complex. It's a straight line from home ownership to wealth accumulation. And if we don't get serious, and unfortunately, although the state's still majority homeowner at 55% home ownership, 31 of our 150 largest cities in this state, the census only tracks the 150 largest cities, or it's like 142, something like that. 31 of those 142, which together represent about, I think it's 20 to 30% of the population. So 30% of households live in one of these 31 cities that are already majority renter, including some of the big ones in the Bay Area, right? Berkeley, Oakland, Sunnyvale, Mountain View, Santa Clara, San Francisco are all majority renter cities with large populations. And again, this is a problem for us as realtors, to be sure, right? This constrains the number of transactions that are happening. um, locally, right? But it also means that employers are up against it because no matter, even if I stretch myself to the absolute max that I can afford to pay somebody, if that doesn't equate to a high quality of life, if you're still renting a small apartment and stuff like that, it becomes not attractive, which is why I think, you see all these terrible outcomes when it comes to housing, right? When we haven't gotten serious on development. And I think there's a lot of reasons why we don't build. Gina asked why builders aren't building here. It costs a lot. Nobody lets them build. You start a new development. The protesters show up and start a lawsuit and file a CEQA claim. You can't get it zoned. You can't get info on your permit. It costs you, 50, 70 grand to get a water meter. It costs you untold hours of chasing down the city on permits and this and that. Um, yeah, Valerie's translating regulations is the short word for all that stuff I just said. But I also think there's a public perception problem. The NIMBYism is huge. Even people in our own industry are really very resistant to new development. We're not connecting the dots. I go to a room and I say, who agrees we got a housing crisis? And everybody raises their hand. And I say, who's cool with me building a few duplexes within a mile of your house? And all the hands go down. And we're suffering on the front end from that. So I think just, more than that, we've got a PR problem on our hands. But, if we don't solve that and get serious, this is what we're looking at. I put together some data just on the outcomes, like why should we care? And the housing outcomes numbers are terrible, right? When you look at overcrowding, that's the percentage of the households that live in these homes that are technically considered overcrowded by the standard of one person to a room, where every room is a room. These aren't bedrooms, right? This is somebody living in kitchens, bathrooms, living rooms. California ranks 50th out of 51st. If you look at rent and mortgage burden, that's the percentage of the households that have to spend at least 35% of their gross pay before taxes, before food, before utilities, for anything, just on housing. And that's true whether it's rent or mortgage. We're 40th, 49th, or 50th. Again, not dead last because we got DC in there, but very low ranking. The amount of people that the government has to turn around and then give money to, either for food or just straight up cash assistance, we're in the bottom quintile there, right? Or even decile. That's only out of 51. And the most important one to me, and this is the one that's like demonstrates what a significant economic consequence this is for us, is poverty, right? There's a one size fits all poverty rate for the United States that's the same whether you live in Ohio or Beverly Hills. And by that measure, we rank only 34th out of 51st. Not too bad, right? But there's a supplemental poverty measure that the United States Census does because that same poverty threshold doesn't make sense in all parts of the United States. So the supplemental poverty takes into account what is the cost of living in your state. The primary influencer of that is housing. And by that measure, California ranks dead last, tied with Louisiana for the poorest state in the nation. So this is constraining transactions, to Barry's point, and why home sales are a lot lower than what that aggregate economic data would suggest that they should be. But this is also why, if we don't figure it out and fix the regulatory stuff that Valerie talked about, or really attack the NIMBY stuff that we addressed as well, you're going to continue to see charts like this, right? Where we're not just we've gone from being a net importer of high skilled, high income people from other parts of the United States back in the 80s up to the 90s, to now one of our biggest exports is our high skilled people that we provide subsidized world-class education to at our state universities, and then they go work in Denver and Florida and Texas and North Carolina and Tennessee, right? If you look at who those people are, they're people grappling with housing costs. Even though people making under $100,000 a year are only about 53% of the population, they're almost 70% of the people who leave the state. It's not the high income, high tax people leaving. If you can afford it here, it's still better to be here, right? And this is where the high income jobs are still, to a large extent. It's the people who can't afford it. If you want to see the impact that it's going to do to our economy moving forward, is if you look at not those people by income, but what are those jobs that those people are doing? And I would posit that that's the really puts it into stark relief, because if you look at out migration per thousand, by occupational category. It's not necessarily our high skilled, high income people, although in recent years, it started to creep up the income spectrum. You see some of our life scientists, some of our architects and engineers, and our middle managers going. But for the most part, the outmigration is concentrated in the industries that I would argue are the most important for our economy moving forward, right? It's our administrative and office workers, it's our teachers, our librarians, right? All of the people we need to educate that next generation coming up. It's our middle managers, it's our transportation, right? Like the rail workers, the trucking companies, right? The logistics, material moving, our tradespeople. How are we going to build our way out of the supply crisis if all of our carpenters and plumbers and pipe fitters, right, and welders have left the state as well? So it becomes an even more vicious cycle. Healthcare support workers, right? These are people that are foundational to economic growth and our company's ability to continue to overperform as well. So that's why I've like kind of belabored the housing supply stuff, but also just to kind of hone in on why, even as my forecast is positive, you don't want to take it for granted, right? The market's narrowed. There's going to be fewer first-time home buyers coming into the market, and you can see that's been the case. We're below trend for several years running now, even when rates were super low. And so I think you've got to do that financial education over the short term to peel off those high income, gainfully employed renters. Over 70% of people say that homeownership is still the American dream. Almost 80% want to own their own home. Basically, none of them know what it means to become a homeowner. We asked 1,000 renters, do you know what it takes to become a homeowner from the standpoint of like qualifying for a mortgage? More than half across every age group, except for people who fought in World War II, said no. We asked how much down payment do you need? An egregious number of people said more than 20% down payments. We also asked if you could get in with lower down payments, would you start looking for a home? 2/3 of these people that thought you needed 50% down payments said I'd start looking if I could get in with lower down payments, right? So that's an opportunity even as we start to work on the structural things. I tell you all the negative stuff to manage your expectations, not so that you throw in the towel, but so that you focus your effort. Find those gainfully employed high income renters where their companies are doing good and go, look, I can get you in with 10% down. You don't need 2 million bucks in the bank. You need a little bit of money. And guess what? I can maybe even get you down payment assistance. Doesn't always work in the Bay Area, but you can get somebody in Martinez or somewhere like that. 80+% of people have never heard of help out there, right? And so on down payment. So even as there's challenges, those are also mirror opportunities for the really kind of proactive agent that knows their stuff, right? I think you also want to manage their expectations. The market's has shifted in favor of you now, but just be realistic that inventory is still pretty tight by historic standards, right? We're not seeing a flood of inventory come onto the market. New listings are still pretty depressed, but like the unemployment stuff, last week's listings are carrying over to this week more because they're just not selling as fast and are selling slower, which is great for you as a home buyer, but don't expect this flood of listings to drive a bunch of price declines, right? You're seeing that days on market are just back to kind of normal, right? They're not egregiously high. Stuff's just not going pending in a week the way that it was when rates were at 3%. Sellers are motivated to work with you. 42% of the actives that were still available for sale on Friday had a price reduction. But again, you just want to manage expectations because those reductions are like in the 3 to 5% range. They're not in your brother-in-law's 20 to 30% range where you're saving hundreds of thousands of dollars. The sellers are more motivated, but they're also sitting on 3% mortgages for the most part, meaning that they're not desperate, right? And so, in fact, as rates have come down a little bit, you're starting to see the homes that are priced right and look good start to sell over list increasingly as this little bump from rates has happened. So you might have waited too long for rates to come down, and now the market's starting to get more competitive again. If you are planning on waiting even longer for rates, I would just suggest that you look at the Fed's guidance on where the Fed funds rate's going to be, and when you put that together with what the bond market and mortgage rate spreads are going to do, it's really hard to envision sub 6% interest rates being sustained for a very long time. In fact, when you look back historically, the only time we get really low rates like that is when terrible stuff happens to the economy. And, it's not clear to me that when the economy tanks and you can borrow for cheap, but you don't have a job, that's like a net positive for you as a would-be home buyer. So that's just my opinion. While you've been waiting over the last 3 years, we've finally gotten 4 Fed funds rate cuts, and rates are about 5 basis points higher on Thursday than they were before the Fed cut rates at all. So prices are higher, rates are the same. The house that you can now afford looks worse than the one you could afford in 2022. You don't wait for rates. You get in when you can and refi when rates go down. The way you get a copy of these slides, Keith, is by, I think, checking your email after this. I think Divina and company are going to email these out after the fact. Again, prices have continued to go up, so some of these are repetitive. And actually, as rates have come down recently, we've started to see the market tick back up. So again, I'm still fairly confident in the forecast of improving sales and prices for this year, but I'm just not expecting it to be that rocket ship upward. The I'm going over time, so I'll hurry up with this, but I think the key for the sell side is just to manage their expectations. Still a great time to sell. You got to price it right and do a lot more on the pre-list side and just have realistic expectations because the market has shifted a bit, but you're still going to get a great price. Just because you sell it for 1.4 instead of 1.5 doesn't mean you lost money. Keep in mind, you bought it 25 years ago for like 80 grand. So that's just not making as much as you thought. That's not losing money. Okay. And that's like an important distinction. I also think you're going to want to focus your efforts on people at the upper end of the economic spectrum when it comes to prospecting, farming, however you have that, because that is increasingly where the action's going to be. They're in the position to stomach these rates and have the economic wherewithal to still afford the relatively high bar to entry. ADUs won't save the housing crisis. What will? More market rate housing available for buy and rent from the entry level all the way up to the luxury across every single type, category, and geography. That's it. Until then, you're going to have high income people affording vacation and second homes, buying homes to hold, flip, and or rent, which is increasingly becoming a thing to hold and rent. Fun fact for those would-be home buyers, the people buying to hold and rent aren't batting an eye at the current economic cycle. They're going to get in while they can and ride that horse into the sunset, right? As those prices keep going up. But again, we just have to manage the expectations about how robust the recovery will be because you still got a lot of people facing capital gains, sitting on cheap mortgages, don't have homes that have been built for them to go move into that they like better than the one they currently live in. And for all of these reasons, I think things are going to get better, but it's going to be incremental next year. You can read this summary on your own time because I know I've gone on and probably have beat these things over the head. But I would just say that, the market will go up. Oops, excuse me. We have a 2% increase in transactions, taking us up to 275,000 units, but that's where we already expected to be last year. So just, keep your seat belts and tray tables and all of that stuff going because I think the volatility is going to outweigh the underlying economic data, and only those that are kind of at that upper end of the economic spectrum are going to be the ones to take advantage. It will be enough to drive growth, but it's just the question isn't how many home sales there's going to be overall, but how many you're going to peel off from whatever that number ends up being. I think, and if you embrace that as a mantra, then sky's the limit. And with that, I would say thank you so much for the opportunity, and thank you so much for your time.
Oh my gosh, Jordan, that's so much. And I think everybody is like overwhelmed. Anybody have
Probably.
questions? Yeah, let's open it up for questions. If you have a question, go ahead and raise your hand and um, let's
Oh, I
see.
can put up the summary slide again here. I see
Yeah.
that. Let
Okay,
me
let's do
do
that.
that. Mm,
And
mm.
then I think we have Maureen has her hand up. She's number one. Go ahead, Maureen.
Well, is there a study or is there any way to get workforce housing that includes a number of units for families and parking for workers? We have a small construction business, but this is a real trade for lots of trades and families. When they develop, if you look at affordable housing, they'll make it 1 and 2 bedrooms because they know they turn over, for rents. And it's like, we need workers that can live nearby. And I mean, and they
Mhm.
build them without parking now. So it seems to be pushing workers, like real workers, like we need workers and I can't get them, they can't, it's not just affordability, but there's not a house that includes a place for a truck.
Yeah. Yeah, well, I think, the best way to get workforce housing again is, we like to focus on the types of housing, but that's why I kind of said one of the unpopular things is like we need market rate housing and all kinds of housing because, the affordable and right types and stuff. It's like we have a sorting issue. There's people who don't need a car and can ride transit and stuff, and they're in these big giant houses with big giant garages and driveways that your workers could easily live in, but there's nothing for those people to move into. So they camp out on theirs for 35 years, way past the point that their kids and grandkids have all moved out, way past the point of wanting to clean the pool and do all that stuff and walk up and down the stairs and what have you. But it's all connected. It's all, these are like there's a whole sorting mechanism. So, like, yes, I absolutely, let's go build workforce housing. Let's build affordable housing. But we also need to build like mansions and just straight up market rate housing and apartments and ADUs and duplexes and everything else. Because I think you would find that the parking stuff might not be as acute because we'd better allocate the people who need the parking would live in the places with the parking. Right. And that's just not an option. There's just all these frictions that mean we not only don't have enough overall, but the stuff that we have is so inefficiently allocated that it leads to all these knock-on problems that I think, that I think I wouldn't say solve themselves, but it would alleviate a lot of these issues if you didn't have these single, people whose kids don't live anywhere in a 3,500 square. They want to move, but where are they going to move to? And they got a low property tax. They got a 2% rate if they have a mortgage at all. They've got all these reasons to not move. And then, that's like that used to be the entry level. There's a professor at USC who talks about how the affordable housing and the entry level family housing, it used to be the old housing. Like when my dad was starting out, right? It was like the person who was further along in his career went and bought that house in the new development that had all the new bells and whistles and all the new like little features and blah, blah, blah. And my dad moved into his house that he had lived in for 15 years. And that was how it was. So I think that we're missing an opportunity there too.
I was thinking grants, like grants for developers that included it like this, maybe the state could create one that includes parking for workers, something like that, that draws people in, that like families instead of just one.
Yeah, they've been successful with like density bonuses near
Ah,
transit hubs, and I think the bonus idea could be extrapolated to anything. What do you want to happen? Make a bonus for it. We'll let them make more money. We'll let you do more units. We'll let you do whatever's your pain point. We'll alleviate it if you do this quid pro quo thing that we want you to do.
good idea.
Any other questions?
Anybody else? All righty then. If there are no more questions, Jordan, I want to thank you. This is always such a great meeting to have you here. We love it,